We're good? Recording? All right, so welcome back to episode number 10 of the Easy Talk podcast. Today we have another special guest, our friend RJ. RJ works with our preferred lender here at Easy Auto. So thank you for coming, RJ. We appreciate it.
They help us a lot, man.
Yeah.
Valuable person, valuable company. They help us put a lot of deals together.
And especially RJ, you keep in touch with him.
Yeah, we communicate a lot. He's been in the industry for a while, so we thought that it will be a good person to bring in because he probably knows more a lot that we do.
Right, yeah. And I mean, at the end of the day, what we want is to bring you guys some value and some knowledge so you guys make good decisions.
And
so that's RJ.
Yeah.
I've kind of been in and around the car business for almost 23 years now. So I've kind of held every aspect in a dealership and on the finance side of things for a long time. So
Right.
kind of have a little bit of aspect for all avenues of buying a car to financing a car to selling a car.
And here, before we start recording, we were talking about that you even had a dealership, right? So you've
Correct.
You've been in both sides of the
Yes.
of the business, and the financing side now, and then before you used to sell the cars.
Correct.
Yeah, so I mean, we got someone with knowledge here. Let's try to squeeze that knowledge and give you guys that. So RJ, let's start with what do you think this past experience that you've having with the financing company? What do you think it's some misconceptions or what it's the most normal thing that you see on customers or?
One thing I hear a lot about, when somebody has not such great credit, a little bit rougher credit, had some problems in their past and everything, they feel like, well, I'm being punished because I'm getting a higher rate now. Right. And I don't really see it that way. I see that, when you have good credit, you're being rewarded.
Right.
For a better rate. You're the only one that can control that. There's unforeseen things that happen in life that cause those things, but you still have the ability to overcome it and fix that. And it doesn't take very long to fix your credit if you are disciplined with it. So,
right.
So taking if you get into that situation and you got bad credit now, you may have lost a job or something tragic happened, put you in that position. You go in and you buy a car, you're going to have a little bit higher rate, but if you do your due diligence and pay it on time, the next time around you won't have that. And so it's all up to you to fix that.
It will help you to build it up and to fix it up. Right. And one question that I had about that, it's because I get questions like I get people telling me how to fix your credit, get a credit card, get stuff like that. So you mentioned getting a car loan will help you fix your credit. How long do you think it would take for, let's say I have a credit that is not so good and I get into a high interest loan? Mm-hmm. How long do you think I will have to pay that car to start seeing some differences on my credit score?
You're going to see a difference within probably 12 to 14 months. Okay. The longer you have something like that and pay good, of course, it'll even be better.
Right.
The one thing I would say, for somebody who is in that situation, one of the key things is just going to be saving up enough money to have a good down payment. That always helps, get you in a better position,
right?
In the long term
to succeed, because ultimately what you want is to succeed within that loan. So
correct.
So you don't mess up the credit even more.
Right.
One of the main things that customer ask us here, they're looking for a car, right? They want to know the financing terms. I'm like, well, whatever I tell you right now before sending the application is just gonna be a lie. Because I don't know the terms. We don't know the terms until we've seen the application. So you working with the lender, what are the key things that the lender is looking at in order to provide, a better rate or better approval? Or
There's really four main criteria that you're going to look at. And number one is the credit. We want to see how you have paid anybody else that has lent you money. Okay,
Right.
so your history there. The second thing is going to be your ability to pay that loan back. So do you have a job? Do you make enough income to, have this kind of a payment, and still live your normal life?
Right.
Because you still got to pay rent and light bills and that kind of thing. The next thing we're going to look at is the structure of the deal, and that comes back to that down payment. Are you in a good equity position to move forward in this? If something would happen. And the last thing we kind of look at is the car itself. Is it the kind of car that if something breaks down, is it cheaper to fix or is it very expensive to fix?
Right.
If it's very expensive to fix, we're not going to lend as much or advance as much on those type of cars.
That's exactly what we were talking about
Yeah.
on the last podcast. I was telling Ishmael that I was looking at a couple other lenders that they have like a very special program for certain makes. The first thing they told me, Dodge and Chrysler
Yeah.
does not qualify for this for this program. I'm like, well, I guess there is a reason for that,
Yeah, and you get some companies that, they've had known problems with, transmissions or whatever it is, and when they're known for that, to avoid them out of a program
Right.
or give them less advance.
Right.
So
Yeah.
and those are kind of things we look at as well.
Makes sense, because at the end of the day, when the lender is given a loan on the car, that's what they own the car for.
Right.
If the car comes back to them, I mean, they're not a dealer. They're not going to sell the car back, at a dealer. They have to send it to the auction, try to get the most money they can. So, if the car has a problem, that's less money they're going to receive, right?
Correct.
That's how it works.
Yeah.
Very correct.
Well, and then also we know this by now, when people start having problems with their cars, that's when they stop making payments.
Correct.
They can decide if they want to fix the car or if they want to keep paying it. So that's what happens with that. And that's why you guys as lenders that already have a big database of cars, what's breaking down, what it's not. You guys know
Absolutely.
which cars have more risk.
And we have enough data now that we can kind of say, with this credit score, with this much money down and this kind of car, if we give them a 48-month loan, we know that, 62% of those are going to go bad at month 14. It's pinpointed that close.
Wow.
And we also know that you take that same person, add 500 more down, there's only like 4% chance of that happening, So there's a lot of data out there, and we use that when we put it into our buy programs and figure out how to buy these, what we're going to lend on vehicles per the customer and down payment as well.
Right,
That's
right.
pretty good. Go ahead.
So it does help when a person comes in and they have a decent credit and everything. It does help if they do have a higher down payment
Absolutely.
on the car. It does help for you guys.
Yeah.
You guys see it as better.
We see that's better. They're in a better position.
More
in the
liquidity,
vehicle.
I'm guessing.
Yes, more liquidity. We know that if they have, let's say, 25% down, and they go out here and get in a car accident, the insurance company is going to be able to pay that loan off, instead of now you don't have a car and you still owe money on a loan that the car's totaled out,
Right.
And that's where gap insurance does help in a lot of cases as well to cover that gap that's still owed. Gap will only go so far. I've seen it to where the gap paid out and they still owed thousands of dollars.
Oh, wow.
So
Yeah. I didn't know that the Gap paid everything.
They usually have a limit. One of the things that I've noticed when we're submitted deals here is that the lender fee, the discount, varies a lot when you add a service contract, right?
sometimes.
Sometimes.
Yeah, you'll see that it'll go up because the total loan value, your loan to value, gets exceeded past a certain point.
And there are a couple lenders like
for you guys, a service contract it's sort of a warranty.
extend the warranty.
Explain a little bit.
Because there's one lender that when I submit an application, they call me back and they say add a service contract. Is there a reason why? Because of the car is not reliable? They want to...
It's kind of like insurance to a lender, really, because with a service contract, you have a deductible. It may be like $100 or something. So if a transmission goes out, you're only going to pay $100 instead of $4,000 for a new transmission.
Right.
Which that keeps them in line to keep making the payment.
Right.
You know, they can afford the $100. They can't afford the $4,000.
Right.
So if they have to do, $4,000, they either let the car go back to the lender, or and walk away from it, or they don't make the payment and the lender comes and gets it.
Right.
Yeah.
I guess it's just a safer play for the lender.
Absolutely, it is.
Getting that service contract added there.
Right. Yeah. I mean, it's always better for them. Another question that maybe you can help us with is, if you have if you're trying to get into a car, but your limitations and everything, what are the cars that people should maybe look into, that the lender will look better and they will maybe have better approvals? And is there a specific kinds or that?
There's a lot of them that work. Mm-hmm. I would look for something that is, dependable. Number one, you want something, that's and have heard the history that they go a long ways. Toyotas, Hondas, when you get into the pickups and stuff, the Ford F-150 is the long-lasting one, the Chevy Silverado. They all do very good, and we extend more on those because we know the history of them. They last. One of the other combinations to that, too, is they are cheaper to fix than a Land Rover or Audi,
right.
And those kind of vehicles. So, if you have one thing go wrong that costs $300 to fix on a Toyota, if on an Audi, that's now $800. So, you kind of look at that when you're extending money to people.
Right, got it. Yeah, it makes sense. So reliability of cars is a good thing to keep in mind. Down payments, the more you have, the banks are gonna see it better. Those are the things that you should be keeping in mind when you're trying to get into a car.
One of the things that I think would be a wise decision is, when you're looking for a car, it's a big investment. It's like buying a house. Yeah. It's like getting married. You're not going to walk out of your house and go find the first person and say, "Hey, let's get married." You're going to shop around. You're going to make sure it's compatible with your life. Once you find the type of car that you're wanting, then save up 25% of, if it's a $10,000 vehicle, and you're like, I got $500, go 4 or 5 more months and save another $500 every month until you got $2,500 down. In 5 months, that car's still going to be the same price. It may not be that car anymore because it's probably sold, but there's a lot more of them out there. But come to the dealership with a good down payment so that you're ready to go when you come in.
It'll make in the long term, I guess, in the whole lifespan of that loan, it'll make a difference for them, right?
Absolutely, it will.
Maybe the interest
rate, shorter term,
and that's a good point, because I have a feeling that people, when you tell them put a high down payment, they feel like they're paying more for the car, because I guess they're paying more money up front. But I mean, in reality, it's just they're financing less money. But people, that's exactly what we were talking about before starting the podcast. Like, people don't really understand how the financing works. And just because they're putting more money up front, for some reason, they feel that they're paying more. But I'm like, no, you're financing less. I mean, you're going to pay it off quicker.
Yeah, and truly, they're saving more money by doing that. Exactly. Because the money that you loan, you're paying interest on that. And if your credit's not so good, you're paying a high interest rate on that. So the less you finance and the less term you have, the more money you're actually saving.
Exactly. And I've noticed, like, looking back at all the customers that we've sold through you guys, like, the ones that put a larger down payment, they're the ones who seem to understand the financing part of things a lot better. They always say, no, I'm going to put this much because I don't want to finance too much, or I want to make sure I pay it off within, 2 years or whatever. The ones always with the lower down payments, they're the one, concerned about, like, not paying the car, so it's a good,
Yeah.
interesting.
And as far as the lending side of it, when they come with a larger down payment, they're putting more investment into that vehicle up front, so
More
the likelihood of
commitment.
them paying the payment is much higher.
Totally.
So,
Makes sense. Yeah.
More committed, I guess.
Yes.
you know.
Exactly.
Yeah, I guess
That's
if,
what it
if you're only putting 500 or something like that,
don't
it
care,
might not
probably.
hurt you as much as if you put
Right.
3,000 or something like that. So it makes sense. Yeah, makes sense. So yeah, I think we cover a few topics that can help you guys out there. I hope you
You
guys
have anything in mind that
Yeah.
you think is valuable to share to people looking for a car or trying to thinking financing a car?
One thing I see a lot of that I think is important for all of us to know is, you see a lot of young people when they get out of college, they get that first job and they kind of feel rich, and, they're making, let's say, $40,000 a year. They go out and buy a $60,000 vehicle because they can afford that, $700 payment. Life happens.
Yeah.
Roll that back down and be more conservative. Really, if you're making $40,000 a year, you should be looking at buying a car around $10,000, $12,000. You need to stay within that 25 to 30% of your annual income on a purchase price, and that will keep you safe to where when life does happen, because it's going to,
Right.
that you're still managing and have a budget set to where you can afford that.
That's good.
So keep it in perspective of what what life is handed you so far.
Good advice.
Now that I have another question, what are the key things for having a cosigner? Because I've seen a lot of people. I've seen the deal structure change a lot. When it's a cohabitant or a spouse, or it's a parent, or any other.
What we kind of look at on the lending side of that is if it's a spouse or a cohabitant situation, we're going to take the higher credit score and base the interest rate off the higher of the two scores because we feel like that's the same household. Okay.
Okay.
When it's a parent, we know that the child's supposed to be paying that loan who has, let's say, no credit or bad credit, and so the interest rate's still going to reflect their credit. Okay. The parent is there to make sure that if they stop making the payment, we have a contact to call to make that payment. And so they're still liable for that loan, regardless
Right.
of who's first or second. And when it's just, say, a friend co-signing, it's kind of the same thing. It's going to go off the lower of the two scores.
So on the customer side of things, it's always better to have a cosigner that's either your spouse or cohabitant, right? 'Cause
Absolutely.
if your credit is not good, and if the other person is, it's gonna improve things.
It's going to
for
improve
you.
it. Correct. And one of the things I see a lot in that is, say one of the other has good credit and the other one has bad credit, they'll go and put all the car loans on the good credit person without the spouse. But then if they ever need another one, they've got too many open auto loans under
Right.
the good credit person, and so they have to add and so it's just better to, if you have a spouse, to put them both on.
Okay.
To balance it out.
Balance it out.
Yeah.
And that allows us to see the total income that's coming into the house as well.
Right.
So
That's good. Awesome. Yeah, I think we cover pretty good things here.
Yeah. Thank you so much.
We really
Appreciate
appreciate it, man. Thank
awesome.
you.
Thank you guys
RJ.
for having me. It's been a
Awesome.
pleasure.
Nice.
Yeah. Thank you, and
All right.
see you on the next one.
We'll see you.
Thank you.